Escape from the central bank trap. And of course, this is about what's on the balance sheets here. But instead of dwelling on that, can I ask you, what do you think has changed as far as the way we should view the Fed now in the wake of that inflation data on Friday and the weak retail sales number?
I think that we can expect the Fed to be a lot more cautious. I think that inflation expectations at the end of last year were a little bit too aggressive. The idea that oil prices and food prices were going to feed into core CPI, that the unemployment would start to see wages growing more than expected, it was a little bit too optimistic. So I think that the Fed will take a little bit of a more calmed approach to rate hikes. I think that the market is already reflecting in its expectations that the Fed will take a little bit of a slower pace in those rate hikes, and while continuing with its idea of normalization of policy, taking a closer look at core CPI in particular, which is surprisingly less positive than expected with the level of unemployment in the US.
How should investors think about this? Because bad economic news or less good economic news should give pause for thought here, but as we know, people have traded bad news as a reason to believe easy money continues.
Exactly.
But how do you think investors should think about it this time round, given that we are so long in this cycle?
I think that the way in which investors should not look at it is to buy the dip on bad news to get into more cyclical stocks. I think that what you need to do is to be very, very aware of that slowdown in consumption, slowdown in investment as well, because there was a tremendous expectation of capex going up. So I think that what you need to be is less exuberant with cyclical stocks. You need to be paying more attention to earnings growth. Going back to the old formula of looking at stocks in which you have good buybacks and good dividends, and being cautious, because you cannot expect that monetary policy is going to go back to QE. It's still a normalization pace. Therefore, taking a little bit of money out of cyclicals that have worked quite well is a good idea.
Let's talk about the Goldilocks rate of interest, because that was really what came up last week, where neutral is, and after Yellen says, well, we're approaching that level, I think the market sort of have really pulled that neutral rate or Goldilocks rate lower from above 4%, where it used to be, to about 3%. Is it even lower than the assumptions of 3%? And is that why we're now hearing comments from the chair of the Fed that we could be seeing Goldilocks within sight?
I think it's going to be lower than 3%. And I think that in any case, it is very, very difficult right now for the Fed to take a stronger action on interest rates when the level of debt continues to be so high, when margin debt is so high. But also, you have to think, if the economy is not growing as expected, if capex is not growing as expected, and if retail sales are not going as expected, and wage growth is not improving, therefore, you have to be at least a little bit concerned about the ability to repay as maturities come closer. Between 2018 and 2020, the U.S. has some, I think it's 5 or 6 trillion of maturities. So therefore, you have to be very, very careful.
So put on the record, the market's sitting around 43.1% chance of a rate hike now in December. What do you think?
I agree with that. I would agree with that. I think that one rate hike is possible. While all this data might be a little bit softer, it is still an expansion. And we need to be aware as well that the Fed continues to be between 250 basis points behind the curve. Therefore, they need to take some action, but at the same time pay attention to the slowdown and to the softening of data. Therefore, that's why I think that you should be very careful about taking an aggressive stance on cyclical stocks, because it's still a normalization pace. It's still an economy that is in expansion, but not as some expected, probably too aggressively after the elections.
On Wall Street, to the big bank earnings on Friday, Citi, Wells Fargo and JP Morgan all released second quarter results. And while earnings beat generally, investors put some other numbers in the spotlight. Wilfred has the latest.
Making headlines has been Jamie Dimon's rant on US economic policy, though this was about the last decade broadly, not specifically today's Washington. And his main point was actually that growth has been resilient.
Since the Great Recession, which is now 8 years old, we've been growing at 1.5% to 2% in spite of stupidity and political gridlock. Because the American business sector is powerful and strong and is going to grow regardless. What I'm saying is that it would be much stronger growth had we made intelligent decisions.
But it's certainly fair to say he's envious of other nations like France, Israel, Ireland and China, who are more proactive, he says, at changing the laws and regulations to benefit economic growth.
We have become one of the most bureaucratic, confusing, litigious societies on the planet. It's almost an embarrassment being an American citizen traveling around the world and listening to the stupid we have to deal with in this country.
The bottom line, though, on the US economy, he was upbeat, saying, quote, "If gridlock goes away, we will grow faster. But if it continues, we won't grow slower." As for the earnings, JP Morgan, Wells Fargo and Citi all saw their share prices decline despite beating estimates. JP Morgan because net interest income underwhelmed, Wells Fargo because loan growth disappointed, Citi because, along with the other two, shares had run up too much in recent weeks. Wilfred Frost, CNBC Business News.
Well, BOA, Goldman Sachs and Morgan Stanley report this week, so we'll get another look at what the US banking sector has to offer investors. Daniel Lacalle is with us, Chief Economist and CIO at Tressis Gestion. Clearly a very upset Jamie Dimon there. I mean, do you think he's got a point? Or was he just a little overwrought on what was clearly a busy day?
Well, look, I think he has a point. I think that the economy in the U.S. Growing below 2% in an environment in which you've had 4.7 trillion of monetary stimulus, 10 trillion of new debt, is definitely very, very little to write home about. It's not very inspiring. So the thing that is really focusing in his comments, that is really interesting about his comments, is that he's mentioning how bureaucratic society has become in the US. And that's one of the reasons, not all of them obviously, but that's one of the reasons why capex in the US has been so subdued, why growth in investment is not what people expected. And the impact of bureaucracy and regulation in the U.S. economy has been very evident. It's estimated to deduct almost 0.3% of GDP, which is not small. So you have to give him a little bit of credit. I think that he was a little bit aggressive, but there's a point. Yeah. What I don't agree is in his so positive view about France, because France is exactly what he is complaining about.
Yeah.
You know?
Yeah, I mean, to anybody who remembers just how real the crisis of 2008 was and how the banking sector was effectively bailed out by the central banks globally, it all just sounds a little bit like crocodile tears, doesn't it?
A little bit.
I mean, these guys have done okay.
Yeah. But and they repaid the TARP, the bailout.
Yeah.
So at least the U.S. banks have behaved in a way in which, okay, you were bailed out, but you paid back your money with interest. That's a good thing. Yeah. However, they needed the bailout, and the banking sector needs to redesign itself for a new era of low interest rates, low inflation, and low growth. It's not going to be like it was in the past.
And it's interesting your words of caution around France. We'll come back to that story because I know there are some around the desk who feel a bit more optimistic.
Okay.
And this week's Trader Poll, we're asking you, with earnings season kicking off, which sector will have the most beats? Financials, tech, retail or healthcare? I know some of you already tweeted tech has been your response. Head to traderpoll.cnbc.com to cast your vote. You can also have your say on Twitter using hashtag TraderPoll. Well, here's a quick look at how we are shaping up for the trading session for Monday here in Europe. The action has been suggesting some green arrows on the opening calls as we count you down to the session. Our futures indicating a pop of about 1/3% on some of these markets on DAX and FTSE futures. They're capped at about 1/10%. So we'll get you all warmed up for the session next half an hour of the show.
Trade forex, indices, shares.
Well, let's focus on Brexit then. UK Brexit Secretary David Davis says guaranteeing the rights of EU citizens in the UK and Britons living in Europe will be his top priority when he heads to Brussels for round 2 of talks with EU counterparts. The 4-day negotiation comes amid reports of rising cabinet tensions. Speaking to the Telegraph newspaper, an unnamed minister said Chancellor Philip Hammond was trying to, quote, frustrate Brexit and was treating pro-Leave colleagues like pirates who've taken him prisoner. Meanwhile, speaking to the BBC, Hammond warned Brexit uncertainty was putting off businesses from investing in the UK.
It's absolutely clear that businesses, where they have discretion over investment, where they can hold off, are doing so. And you can understand why. They're waiting for more clarity about what the future relationship with Europe will look like. And the way to get the economy moving, the way to restore business confidence and then consumer confidence is to give as much clarity as possible, as early as possible, which is why I have been talking over the last 4 or 5 weeks about the importance of a transition arrangement. And I believe the great majority of my colleagues now recognise that that is the right and sensible way to go.
The UK's economic growth will continue to struggle this year as rising inflationary pressures and muted earnings growth weigh on consumer spending. That's according to a new report by EY's Item Club, which also says that while Britain's election result increased uncertainty, it has enhanced the prospect of a more business-friendly Brexit. Peter Spencer joins us, Chief Economic Advisor, EY Item Club. Nice to see you this morning, Peter.
Morning.
I'm pleased to say that you have clarity around what Brexit could look like, because I've got to say I have none. And Philip Hammond's comments over the weekend suggest a transition deal, but if you can consider what Gove and Johnson have been calling for, it doesn't feel as though that bridge is going to be forthcoming.
Well, there is massive uncertainty hanging around it, but the fact is that the pretty clear no deal scenario that we were looking at before the election, the hard Brexit that we were pretty well focused on before the election with the cliff edge in March of 2019. It's pretty clear that that's much lower possibility. So you've got a range of possibilities, but the most obvious thing for them to compromise on within the Conservative Party is some sort of transition agreement. I mean, even Ian Duncan Smith is talking about this in terms of an interim arrangement. You know, there are all sorts of euphemisms for what basically is pushing the can down another couple of years down the road.
To what extent do the assumptions rely on the status quo, that Theresa May remains Prime Minister and we continue down this path? Because a bunch of other scenarios have been cited. You get cabinet reshuffle, that May does have the ability now to consolidate her power and then take on board some of the integrity challenges of the cabinet. One option, the other is that she's replaced, so she's not going to be the leader to take us towards the path of Brexit.
Well, again, there's massive uncertainty, all sorts of possible outcomes, but the point is that those alternative outcomes are really not too bad. I mean, for example, should Theresa May go, well, her red line over the European Court of Justice, which is going to hold a lot of things up, if it holds in place, that will go with her. So I wouldn't be too worried about her demise or any of the kind of changes. A lot of those changes could be for the better.
So you mentioned transition period, but however, transition period means more uncertainty. Doesn't mean confidence for business, doesn't mean confidence for consumers. At the same time, how likely is it that the European Union will agree with a transition period? Because it doesn't look like something that would play in their favor in the view of what they want to give an image of strength and obviously not to create a ripple effect to other countries.
Well, they've already said that they're okay with that kind of transition agreement. And again, the basic point is that it's much better to have another 2 years of the present trading arrangements to get everything sorted out, not just on the government side, but also for your own business, than, you know, to be staring at a cliff edge just 18 months out there. Sure. I mean, you know, when you consider the alternative, as Maurice Chevalier said, it's really not too bad.
Okay.
How How inflationary do you think HS2 is going to be? I mean, the government has just announced this morning, I think, that they are going to greenlight £6.6 billion of spending. That's what they're talking about, 16,000 jobs being created through the process, but ultimately this is a near £60 billion project. If the foreigners are leaving because they're concerned about the Brexit negotiation, how do we fill those jobs without generating some wage growth?
Those jobs are relatively distant still. We are still looking at, essentially a 10-year construction period, and that's just for the first stage if it goes ahead. If there are labour shortages, which I don't think there will be, I think it's pretty clear that the government understands that business really does need skilled labour, and that with our educational system and apprenticeship systems being pretty second rate, they're going to have to import labour for those kind of projects. So I wouldn't really worry too much about that.
Do we need this form of fiscal stimulus at this point in the cycle, given the level of government debt that we have?
We're getting to the point, Jeff, where we need every ounce of demand that we can get, whether it comes from the ill-fated consumer. It's not going to come from business investment, as we've been hearing. But, if government can borrow at negative real interest rates, effectively, paying the money back in much smaller quantities in real terms than it takes, with a nice, shiny railway to boot, then, of course, it's not a, infrastructure spending with those kind of interest rates is not a bad deal at all.
There's a market consensus that the weak exchange rate is going to be inflationary going forward, and that will have consequences, obviously, for how good consumers feel about their lives or otherwise. But we're back at around 131 to the dollar. That's the strongest we've seen the rate since September. Do you think there's actually a chance that maybe some of the economists are wrong on this, that the pound increasingly reclaims some of those losses around the Brexit vote?
Well, inflation was always going to be a thing for 2017. We knew that this was a one-off blip, so to speak, that would pass through the system like earlier blips. The MPC knew that, okay, they're getting the jitters now that they actually see the numbers. But the fact is that, as you say, it's not just the pound back at 130. It's the fact that oil, all of those commodity prices have come off those February highs. Industrial costs, which have been rocketing, 20% increases, those have stabilized and are now going to start coming down. We are saying that the pressure on the CPI, the Consumer Price Inflation Index, will ease considerably and will be back in line with the 2% target by the end of next year. So I think the economists got it right by saying that it was a one-off.
Daniel, I know you've done a lot of work on exchange rates and trade demand, and it's not really working for the pound. Weaker pound should have driven up demand, according to some theories, but there's been a real sort of gap in that narrative.
Well,
Why?
not really. I mean, there's the mirage that devaluing increases exports in a globalized economy doesn't happen, especially when there's currency wars. But I think that the situation for the UK is actually what works much better for the UK is that inflation is not going to be rising to levels of 3%, because when you don't have wage growth, as you have seen, you had the economy growing and employment is very, very low. However, at the same time, wage growth is very poor. So you need to have, in order for consumption to continue to be strong, you need to have low inflation. Actually, low inflation is not a negative here. It's actually the opposite, especially because what you care about is core CPI. As you were mentioning, it's ridiculous. Nobody has ever left a service station saying, oh gosh, gasoline prices came down. No one is worried about that. If food and gasoline prices are down, that's a positive for an economy like the UK. So I think that is something that is positive. I think that another thing that is positive is that what the pound has lost is the shine that it had because of the risks of the euro falling apart, not because of its own economy. And now, relative to the dollar, because the data in the US is softer, therefore, the pound is trading at the range at which it was trading for the past 20 years, except for the blip of the euro collapse risk.
Peter, so where does this leave interest rates for the UK? Because judging on your previous comment, we really shouldn't see much movement around policy rates. And that seems to be what Mr. Khan has been saying. But as we know, Andy Haldane has been suggesting that there need to be rate hikes sooner rather than later. So how do you think we should think about the direction for rates in this economy?
Again, I think given the tensions within the MPC and the various statements that have been made, some of them contradictory by the same person who shall remain nameless, it's massively uncertain. But the fact is that this economy is slowing. They have said that they're going to be looking to see if investment and exports can actually fill the gap left by the consumer. Well, that certainly isn't going to happen. And as a result, our bets are that interest rates are going to still be on the floor basically this time next year. So, we're looking for a pickup in the economy essentially over the next year to basically pull the interest rates off the floor.
Peter, nice to see you. Thanks very much for coming in this morning. Peter Spencer, Chief Economic Advisor for the EY Item Club. Daniel's going to stay with us and we're going to move on. China's steel output hit a record high in June, fueling worries of a growing glut. Bigger profits from rising prices helped boost production above 73 million tonnes. Aluminium output also soared to the highest on record. The figures come amid a dispute with the US, which accuses China of flooding the market with cheap steel. Alan Alsher joins us, senior analyst at Macquarie. Morning, welcome, nice to see you. Are we at a point here where Chinese steel production rolls over running into the second half?
It is quite difficult to see the Chinese maintain this level of production into the second half of the year. What we've seen certainly over the last 18 months is that the significant recovery in the Chinese economy has been driven by reflation, restocking and real estate. And we saw economic activity really peak in the first quarter of this year, and that restocking and reflation was replaced by disinflation and destocking into really the middle of the second quarter. That put some downward pressure on commodity prices, but certainly steel production has been surprisingly strong, and it's been really held up by strong real estate demand. But as we push into the second half of the year, it's difficult to see that being maintained. We do see it starting to slide over.
Would your expectation be then that the market moves to re-rate the miners on that basis, that actually the good run that we've seen is actually coming to a close here?
It does present a little bit of a headwind for the miners. There's no question. Having said that, commodity prices at this point are a lot higher than most consensus forecasts. So there will be some upward pressure to earnings estimates over the next couple of months, which should help support prices. But the theme for the miners at this point, given that cash flow generation has been really strong, is cash returns to shareholders. And that's going to be a key focus in upcoming results.
Also streamlining businesses. That's still been cropping up, whether you want businesses that have this wide footprint geographically, but also in terms of what they produce, what's in the mix of commodities. And I think for me that's been really interesting. As a long-term investor, you always assumed that you wanted a wide spread of assets. What do you think is the most appropriate to shield investors when you look at all the gyrations around iron ore, steel, copper? Do you want a big footprint still for a diversified?
Well, there's no question that there's been the whole strategy around diversification for diversification's sake has been called into question, and we've seen some of the major companies essentially unwind the big M&A that they've undertaken over the last few years. BHP spun off South 32, which was a lot of the assets essentially that they acquired in that BHP Billiton merger in 2001. Rio Tinto is selling a lot of its coal assets. So there is a greater focus on commodities where management believes there are structural advantages being there and being exposed to commodities over the long term. We certainly think a company like Glencore has a fairly attractive commodity mix. It's exposed to commodities like copper and zinc, which are supply constrained over the medium and long term, whereas companies that have exposure to bulk commodities like iron ore, and to a lesser extent thermal coal, perhaps not as well positioned.
You were mentioning the relative strength in the previous months on some of the commodities, but it's prominently been driven by weakness in the dollar more than supply-demand changes. What do you think is going to be the driver once we see all this inventory feeding into the market, all this inventory built in China? What do you think? Do you think that the world is going to be able to absorb part of that inventory movement that they want to export? No?
Yes, certainly when it comes to steel, for example, and aluminium, as was highlighted, these record levels of production, they're going to need to find a home somewhere. So as economic activity slides in China in the second half, you would expect a pickup in net exports. Of course, you do have trade barriers being erected in Europe and the US, and that's leading to a bit of a divergence in steel prices and some local markets that are developing. But it will put downward pressure in certain select commodities. But again, in base metals, for example, you just don't have that glut of supply coming through. Supply has not been as responsive to increases in prices as is the case, for example, in iron ore. So we really do think that, for example, in copper and zinc, you should get prices at least supported at current levels, if not a strengthening of prices into year end. And a few things to watch out for in copper, for example. We've seen resource nationalism in Indonesia.
Sure.
We've seen striking action by workers in Chile, and that's all disrupted supply.
Alon, thank you very much for joining us today. Alon Olsha, who is the senior analyst at Macquarie. The market open almost upon us. Stay tuned for all those opening numbers.
Thank you, Karen. Ben Gutteridge is with us, head of fund research at Brewin Dolphin. And Ben, interesting to see that unlike many of the strategists who are coming through the desk at the moment, you're a little cooler on European equities and you're more interested in still owning the States. Why?
Well, we're sort of recognising just how strong some of those, tech, recognising, it's widely known, these transformational growth companies that dominate the market, it's this sort of winner-takes-all thesis rather than the valuation argument that looks so troubling. If you do have this sort of winner-takes-all element from, these leading innovators, then these valuations can push on. So, we're not bearish European equities. I think we're just recognising what a fantastic operating environment it is for these large US tech businesses.
The story in the United States has been somewhat improved by, I think, weakness in the dollar, which has encouraged international investors to take another look at the US market. But are you disappointed at all with the banking sector outlook, given what we saw on Friday?
What we've seen on Friday, the numbers look. I think there've been lots of earnings downgrades into sort of reporting season, so we can expect banking numbers as usual to outperform. But on whole, the banking story, the net interest margin story is under pressure from a more dovish Fed. Loan growth is not looking particularly exceptional, but these businesses are still further along in the cycle, in the recovery cycle, or these banks, sorry, are further along in the recovery cycle than elsewhere globally. And those disappointing net interest margin stories and loan growth stories still look more promising than elsewhere across the globe. So the banking story is not so hot. It's one of those that comes in and out of favour, but doesn't derail our US equity view.
One of the things that at least I believe is that the European market has gone from being cheap to being very expensive very quickly. And on the other side, in the US, with the correction, what you've seen is that if you take away those high-tech companies, that valuations are much more attractive. So one of the things that might be helping the US market right now is valuation relative to earnings estimates, buybacks and dividends, which are not helping in the same way the European market. Do you think that that on top of that, the downward pressure on inflation expectations could take a little bit of steam off the European market?
Well, I think you're right to point out, the median valuation story in the US is actually pretty supportive at this stage. I think, the big story is, one of the big stories is the inflationary pressure so building sufficiently to allow Draghi to announce the removal of the levels of accommodation that they're currently providing. And you know, that may well be the case, and you know, the euro's seeing some upward pressure, and again, that's not great for European businesses. So the central banking story, the inflationary pressures, does offer some divergence in the favour of euro appreciation at this stage, which isn't great for European equities, to the sort of point you're making about dollar and US equities.
Yeah, I mean, we're going to get another look at the EU inflation print today. Probably confirmation at 1.3%. I mean, it's hardly forcing Draghi's hand at this stage, is it really?
No, I agree, but there is a number of growth elements that are working quite well. I think we've seen a good recovery in the labour market, and it's not about embarking on an aggressive phase of hiking. It's about sort of having enough sight of the inflation target coming onto the horizon that will allow Draghi and the central bankers to remove a very generous level of accommodation. Of course, any movement on that such can give, even those marginal moves can give bond markets a bit of a fright. But I do think there is an intent to begin the process of accommodation removal.
I think that what you have is not what they do, is what they say they will do. And I think that what's happening with European markets is that people are getting very, very used to the fact that nothing is going to change. But with 1.3 trillion euros of excess liquidity, the European Central Bank has to do something, because at the same time they're running out of bonds to buy. So if they don't do it, then they can enter into a really big problem if all that excess liquidity starts to drag on the economy.
Yeah, but there's a mea culpa here at some point, isn't there? Because we've got structurally weak inflation everywhere, and yet the central banks at the moment are just locked into this mindset where, everything is a nail and they have a hammer and they need to hit it. And at some point they've got to acknowledge that actually what they're doing is not changing really the profile for anticipated inflation from
Absolutely. At some point, people have to realize, and central banks need to realize, that low interest rates do not create inflation. Low interest rates perpetuate overcapacity. It's very simple. We have too much capacity, and you're just making zombie companies. The BIS figure of zombie companies is unbelievable. It's just gone through the roof, of companies that are simply just being refinanced over and over. So it's not, if they continue with the policy of low interest rates and excess liquidity, the only thing that you do is create disinflationary pressures.
But I mean, you make the point, Ben, that we're late in the cycle, but the cycle's not yet over. But I mean, there is excess capacity. You get the sense that the quality of this cycle has been relatively weak in economic terms. When do we need to panic? Or do we not? I mean, do we just sit in there as long as the central banks don't move? You just keep drinking the Kool-Aid?
Well, I mean, you do put it like that, and it sort of seems reckless to be sitting in equities, but actually it's, if you put it in a more thoughtful manner, it does.
You're accusing me of not being thoughtful here. Come on, reframe the story.
So combining both of your points, I do think there is a recognition from central bankers that ever-easy policy is, yes, creating excess capacity. These have deflationary pressures. And therefore the tone of central bank communication is changing, reflecting that there is now a greater debate within central banks. But at the margin, the data isn't strong enough for anything particularly hawkish, which means, on balance, accommodation, which on balance means, no real recessionary threats, going into the second half of this year, into early next year. And on that basis, the end of the cycle doesn't seem imminent. And if you want the conclusion, equities look like the better asset class in that environment.
Okay, let's kick the ball back to Karen. What have you got for us?
I'm looking at HS2 again. Basically, contracts awarded for this high-speed rail project. It's been somewhat of a lifesaver for a couple of stocks in the sector. Well and truly under pressure. Carillion spiking 6.1%. This is a stock that's been well and truly hit by a procurement blitz from Whitehall after you've really not had much in the way of contracts awarded lately from the UK government. In fact, the value of contracts won by this particular company in the past 12 months has been down about 81%, just as debt has been spiraling. So news that it's been one of the key contractors to win out has been quite important to its stock this morning, but also Skanska. You may recall Friday, as we were covering stocks that had a profit warning, and some of the issues were around lower than expected production rates, project delays. It's also had a seat at the table around this contract process today, but you can see the stock still suffering somewhat of a hangover from that story Friday's session. Down 0.7%. In other news this morning, Pascal Soriot, the CEO of pharmaceutical firm AstraZeneca, is to host a results call with reporters on the 27th July. Now, this comes amid speculation about his future at the firm, following reports he could be leaving for Teva Pharmaceutical, so perhaps some clarity from the company. And sales at H&M rose 7% in June. The retailer also added more than 400 stores worldwide. It announced a move to start reporting sales figures by quarter instead of by month. Thank goodness, getting sick of reporting them. It says more clarity for investors who see a longer time frame rather than every month.
More clarity, but less clarity.
Well, you get the overall trend, don't you? I mean, I must say, I sort of was thinking, gosh, is it time for more H&M sales?
Yes.
Because you do think they're by quarter, because most companies report by quarter, but every other window of opportunity, it seems, has been the case for H&M.
Coming up on the programme, earnings season in the US gets into full swing as big banks report second quarter results. But strong earnings aren't the only numbers driving stocks. We'll explain in just a moment.
Meantime, we are going to take you to what happened on some of the banks in just a minute, but...
Look at that. That's a very important handshake, isn't it? David Davis, Britain's Brexit minister, in Brussels, meeting with his counterpart, Michel Barnier, for their first full round of talks of Brexit negotiations. It wasn't quite as grim-faced as the handshake we saw between Mr. Macron and President Trump. Was it? That was a real white-knuckle handshake. But look, the body language is intriguing here. You see David Davis with his arms crossed a little bit there after that handshake, and now they're walking up to the podiums.
Where's the briefcase?
Where is the briefcase? The special Faraday-proof briefcase. Can we listen in? Can we see if we can pull up some sound? I'm just talking to the director here.
Negotiations this week. We will now delve into the art of the matter. We need to examine and compare our respective positions in order to make good progress. As you know, our negotiating groups will work on citizens' rights, on the financial settlement, and other separation issues. Our coordinators will engage in a political dialogue on Ireland, and they will work on the enforcement of the Article 50 agreement. David and I will be in contact throughout the week. Rendezvous to take stock together on Thursday. Thank you.
Thank you, Michel. It's good to be back in Brussels to open the next formal round of the negotiations. We made a good start last month, but as Michel says, we're now getting into the substance of the matter. And as you've heard, it's four categories, really. The issue of citizens' rights, the issue of finance, the issue of separation issues, and, of course, separately, Northern Ireland. For us, it's incredibly important we now make good progress, that we negotiate through this and identify the differences so that we can deal with them, and identify the similarities so that we can reinforce them. Now it's time to get down to work and make this a successful negotiation. Thank you very much indeed.
Jeudi, Thursday.
All right.
Now we have to work.
Thank you. Work. Yes, that's right, work.
Now, was it, just remind me, chaps, was it Jean-Claude Juncker who said, without any sense of irony, that English is a dying language in Brussels and that things wouldn't be happening in English any longer?
Exactly.
I have to say, it was good of Michel Barnier there to speak English so that us poor lingophones could actually understand what was going on.
A much more different approach. What we're seeing here in the body language and the comments from what we saw in the past from Schäuble, from Juncker. I think that this negotiation could not be about a zero-sum game, about making the other look like a fool. And obviously, everybody is looking forward to a negotiation that is, that is logical, that puts together the key things and lets both sides get on and improve.
I have to say, I mean, I'm terrifically encouraged. That was a very brief press conference but it sounded like a couple of grown-ups have finally stepped onto the stage. And the fact that they addressed each other as David and Michelle, rather than defaulting to surnames, which would suggest some distance, it did suddenly feel like we're actually in a game here, rather than the nonsense we've been hearing with megaphones.
Think about it from when you heard Schauble say, you know, the UK cannot change taxes, or Juncker say, you know, I think it's a big change.
Does this say something about Europe and the strength of Europe at this point? I mean, there's been a sort of a change in the perception after Macron was elected. He's tried to restore this Franco-German axis, and there's been sort of a stronger message about reform taking place in Brussels. You've got better numbers coming out of a lot of the Eurozone and EU countries. So on the continent, things look better. You don't almost need to punish the UK anymore, because the data's coming through weaker by comparison. So that sort of, you know, story about how negative it is to leave the project kind of exists in the backdrop. So
I think what we're seeing? Both sides have changed. From one side, as we were mentioning before, the possibility of a hard Brexit is disappearing, while at the same time the European Union is seeing that there's not a backlash towards the European project. So those two things sort of make a more, let's say, calm and collected approach to negotiations.
Ben, to what extent do you think there is a discount in UK share prices at the moment, just because of the nervousness around the Brexit negotiation?
Well, I mean, based on the positivity I'm seeing around this table, quite a huge discount. But I think I would share a lot of that optimism. I think you still have to weigh up the probabilities of, you know, no deal versus a reasonable deal versus the status quo. And when you do your probability scenario analysis on that basis, I do think the pound is overly discounted. And also, if you combine the idea of potential transition approach that's sort of being discussed more and more, on that basis, no, I do think UK assets, stocks, have some relative merit at this stage.
What about the FTSE specifically, though? Because if you look at the direction, it almost feels that we're churning around these levels, around the 7,400 mark. We've sort of dropped a bit, we've gone back up. We're not really going anywhere fast, but we did go somewhere fast. So is it just a consolidation phase? Is there more to unlock at this point to the upside?
Well, I think the global markets are going through a similar sort of churn. I think there has been some pause to reflect on this more hawkish tone from central banks and the bond market reaction we've seen from there. But as things settle down, I think the next phase on the balance of probabilities would be a move higher on the thesis that the global economic recovery is chugging along and not yet to be derailed by central bank moves. But I don't think, on a relative basis, even though we think the pound can be stronger, on a common currency basis, i.e. if the dollar's weaker, but that sends, US shares higher. Actually, if you add up the currency and the stock market moves, sterling strength combined with stock market strength is going to be a relative winner.
I mean, there's been a consensus, I think, that you buy the overseas earners on sterling's weakness. You avoid sterling-based cyclicals, worries about growth slowdowns, as Peter Spencer articulated earlier, suggest that there will continue to be pressure on UK cyclicals at this point. But I mean, if we get a better tone in the Brexit negotiations, which I don't think anybody, no one's expecting them to go really well and smoothly, but if we actually get a better tone, is there a sector in the market or a stock that you would feel happy going back in and having another look at because you feel it's been beaten up too much?
Well, I think these, I don't want to be too boring here, but I think these things have to be done in a sort of marginal, thoughtful fashion. I don't want to be sort of swinging for the fences on this currency trade, because I do think it could easily be undermined and the pound could suffer some weakness. But on balance, I agree. I think the Brexit negotiations, the tone should improve, and that there is some cheapness in domestic cyclical businesses within the UK. So, taking sort of a more mid-cap approach in your investing relative to large cap at the margin, I would think would be sensible at this time.
And just very briefly, how worried are you about political developments in Italy? I know you've suggested that's one caveat for European equities at this point.
Well, I don't see this as being the route out for Italy of the European Union, but you have Five Star Movement polling second, and we suspect they'll be running on an anti-Euro ticket. So these sorts of things it does seem as though they've had a good win of establishment victories in Europe, and that does pose a threat. So yes, we are mindful of that, and another reason why European equities are not so hot for us at the moment.
Ben, thanks so much for coming in. Good to see you. Ben Guttridge, Head of Fund Research at Brewin Dolphin. We're going to squeeze in a break. We'll be right back. When we come back, balance sheet rebuilding. We're going to talk about the outlook for the European construction industry following a nasty string of profit warnings from some of the sector's largest companies. But there is a silver lining in the cloud for those who are getting HS2 projects. We'll talk about that. Daniel, this is a troubled sector. I mean, you look at Carillion, it trades on a PE of 2.3.
Exactly.
Which suggests that it's very cheap, but I don't see people rushing in. And on a 5-year performance basis, Balfour Beatty's been a disaster to own, Carillion's been a disaster to own. But they are, by dint of what they do, victims of a cycle that's really worked against them. Is there any prospect here that actually, as governments now start to spend to stimulate fiscally and the central banks step back, that there is a sweet spot coming for the infrastructure companies?
Infrastructure companies have been a classic case of value trap. The multiples have always looked very cheap, but the profit warnings, all these problems that you were mentioning very well, very deep-rooted problems in the business itself, because when the cycle goes up, costs go up, so margins don't improve, and the cyclicality component is lost in many cases. Now, the case is, after so many profit warnings and after finally the sector realizing that those problems existed, because many of them denied them for a very long time, you probably start to have, an opportunity to start to look carefully and without getting too excited about these companies, because, now that we're passing the problems of lack of expenditure, etc., and that governments are paying more attention to infrastructure, it could be an improvement now that the issues have been addressed, or at least are being addressed in what you were mentioning before.
The part that puzzles me is why some of the home builders are doing particularly well still. If there are capacity issues in the sector, you'd think it would impact all of the players. It wouldn't just be company specific. And, we've seen average selling prices still increase, production rates still hit by a number of the companies. So why is there a disparity across the industry?
I think some of it's down to the internal controls that individual companies apply, and I think Bovis suffered from the fact that their controls were found wanting. So the ability to increase output and maintain quality is the biggest challenge that we have, certainly in home building at the moment. And there are some companies that are actually able to buck that trend. So Barratt's is an example of a very large house builder in the UK that's maintained its 5-star rating. It doesn't mean there aren't problems behind the scenes, though. I think what's happened with Bovis is become high profile. It's been linked to a campaign on social media where the consumer has decided to fight back, and that doesn't mean that's not happening elsewhere and it's perhaps suppressed. In home building as well, margins are greater. So unlike general contracting and infrastructure projects, which are way for thin margins, home building still has a decent margin potential. So I think the issue is the individual structure of companies and how they set themselves up to deal with this quality and capacity issue is quite variable. But I do think we have a much broader issue than perhaps we're seeing through what we're seeing, certainly in terms of Bovis's problems in recent times.
On that note, outsourcing is very common throughout the industry. Is that part of the problem, do you think? Is it because there's a mercenary aspect, and so perhaps with regards to quality, there's less commitment potentially from the people who are actually executing?
Yes, one of the big problems the construction industry faces is that it relies very heavily on a subcontracting model. So actually the level of vertical integration in many of these big businesses is quite low. So main contractors, the Carillions and Skanskas and the Bovises of this world actually do not necessarily employ the people that do the physical work on site. Most of that is through subcontractors, most of it is self-employed labour, and I think this is a sort of a change we've seen in the last 30, 40 years in UK construction. It's not unique to UK, but it's our model here is very heavily reliant on subcontracting, which, as you say, I think brings risks around control. The level of control you can deploy when you're not actually employing the people that are physically doing the work is less, and the checks and balances around checking people's qualifications and skill sets is being diluted as well, I think.
Mark, thanks so much for coming in. Good to hear from you. Mark Farmer, CEO of Cast Consultancy. Gemma, thanks very much for coming in and helping us out with the conversation. Daniel stays with us. That was NBC's Kelly O'Donnell reporting there. Let's get back to Daniel Lacalle then, Chief Economist and CIO at Tressis Gestion. France. Keep threatening to talk about it, so let's do that. When does Monsieur Macron deliver on the reforms?
It is very, very difficult. I think that he has strong support, but remember that we have seen this before. We saw it with Sarkozy. Tremendous support for reforming the country. The country has been 2 decades in stagnation, has completely separated itself from Germany when they were in similar terms of growth, employment, and all of the macroeconomic metrics. So the risk here is, what support is he going to get from what he calls a sclerotic economy, he himself? The first problem is the enormous pressure that he will get from the unions and from the public sector. The workforce in the public sector is about 22% of all of the labor force. So it's very, very difficult to undertake big reforms. The second one is that the tax cut that he is mentioning doesn't put France even close to competitive in terms of other countries.
At 25%, you say that's not competitive still?
No,
That's
not
the
25.
target.
No, but if you look at the tax burden in France, is the highest in the OECD, one of the highest in the OECD. So the problem that France has, and one of the highest in the European Union as well. So the problem is that tax cut, if it's not significantly stronger, and more importantly, if it doesn't go to reducing taxes on labor, which is the big problem for employment, it's not going to end up delivering. It might...
It's a series of problems, isn't it, when you talk about the tax system for employees? Not just the tax rate, take that on board, but also the cost of having an employee.
Absolutely.
Because if you want to terminate the employment, there is very strong ability of the employee to turn around and sue the employer and demand a fairly large compensation package. Until those compensation packages are taken down and the risk to the employer is lessened to an extent, you've got to say employers, unless they have very clear clarity on their growth story, are not going to take on employees.
Yeah, and it's excruciating and very, very complicated for SMEs. Very, very complicated for SMEs, which at the end of the day are the largest part of value creation and job creation in France. So the tax system, the bureaucratic system, and the rigidities of the labor market are too strong, and the reforms that he is mentioning only barely tackle the problem. So that's the reason why I find it so complicated.
How could Macron get around the unions? Because there have been ways already where he's gotten around obstacles. I mean, Donald Trump, the white knuckle handshake that didn't go so well, and now there's a dialogue and a conversation maybe bringing the US back into a climate change agreement. I mean, that's quite a U-turn. Haven't got there, but something could actually happen at this point from almost no outcome. And then if you see that the corporate tax changes, we're talking about tax harmonization with Germany. It's almost making it as though it's a Eurozone problem, not a France issue to be addressed. So there are two very big obstacles he seemingly has navigated in a short period of time. So what would he do with the unions?
Well, I'm going to say first, every time I hear tax harmonization in the European Union, it means increasing taxes. Harmonization is always done to the highest. But let's, jokes aside, the other important thing of bringing the unions, you have to bring the unions to work with management in the companies, like the Nordic countries do. Everybody talks about the Nordic countries and the union participation within the Nordic countries in the economy. Why do they do that? Because they're within the companies, understanding the business, understanding the way that companies grow and how they're going to create more jobs and invest more. Not participating like, in which you have to pay them to simply be there, which is the problem in France. As you know, it's a country in which if you have 50 employees, you basically need to have a union guy or woman simply just overseeing things because the unions say so. So you need to bring unions to management and to understanding how businesses works, because if it doesn't happen, they continue to be just a burden, and that is the way that, for example, the Nordic countries addressed the issue, and I think it worked.
So how long has Macron got here? How long's the honeymoon period before the gloss comes off?
I'm going to say that the honeymoon period stops at the end of the year. I think that at the end of the year, you will see that in terms of economic growth, in terms of ability to change capital structure, in terms of regulation, it is much more difficult than what we are willing to give him credit for.
Okay. Daniel, thanks for being with us this morning. Good to have your company. Daniel Lacalle, Chief Economist and CIO at Tressis. Jess, John, for Karen and myself, a very good morning to you. Stay with the channel, though. Steve will be up next with Street Signs.